Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, October 28th. I'm Jay Greg Nanny, and here joining me this week is Ian Saunders. And a lot going on this week. The last week of October, last podcast of the month of October, but also it's a week that is seeing a lot of earnings news coming out of especially a number of the S&P 500 companies. We'll touch on that a little bit later. It's also the last full week leading up to the U.S. presidential election. Obviously, a lot of angst, uncertainty around that. And then also you've got a lot of uncertainty around the COVID stimulus bill or lack thereof stimulus bill. And so that's creating a lot of volatility, at least here of late in the market, to the extent that, as we're recording this, the Dow is down a little over 800 points. The last few days, the last few trading sessions have been down to the extent that, the rolling 3-day period for the S&P 500 has seen the S&P 500 pull back about 180 points, 180 actual points, not percentage wise, but 180 points. And, that is, certainly a notable number. It's not enough that we've seen the S&P 500 pull back 10% or reach what many would call a correction territory. Nonetheless, it is certainly something that we've seen the volatility creep back into the market a little bit, a lot of events, a lot of things going on around it. And so what we wanted to do today is, number one, provide a little bit of perspective as it relates specifically to the S&P 500 and the market in general as we move through the next couple of trading sessions, as we get closer and closer every single day towards November 3rd, which is the U.S. presidential election, and provide a little bit of perspective around that. And then lastly, the other thing that we have going on this week is the fact that this week, that October, ends what historically has been known as the seasonally weak period in the market. Like a lot of things in 2020, the seasonally weak period has been anything but weak for the equity market. Nonetheless, we'll take a little bit of look at the historical trends that we've seen as we turn the calendar to November to what is historically known as a seasonally strong period in the market, and look at some potential ways and ideas, strategies that you might consider as we move through the market into the month of November. So with that said, let's take a look at the S&P 500 chart itself, Ian, and what are we seeing there with respect to recent market activity, what that has done to the chart of the S&P 500, and maybe where we see some key support levels.
Yeah, absolutely there, Jay. And like you said, with all the different stuff going on this week as we head toward the big election day there next Tuesday, I'm seeing a fair amount of movement on the 20-point chart of the S&P 500, which is that kind of the main chart that we've been continuing to monitor over the past several weeks and several months, honestly, here, going back here through 2020. So in looking at that chart, we saw the chart rally about 10% from a low there in September of 32.20 after getting 3 consecutive sell signals there on that 20-point chart, to rally straight up in a column of X's all the way up to get back towards those highs that we reached in September, but only reach that 35.40 point there earlier this month. Since that time, over the past few days here, the index has reversed back down into a column of O's, and then with today's movement, printing another 5 O's on this 20-point chart to bring us down to a current chart level of 32.80. As you said, this is not quite getting back, at that 10% reversal level. That would come down more around the kind of 31.90, 31.80 territory. So we're sitting at just under a 7% loss from those early October highs there at this particular point in time. And another interesting thing to note is that, as I mentioned, we have that 10% kind of correction level would be that 31.90-ish point. And we have some pretty near-term support offered just before that there at 32.20 on this 20-point chart. Moving further from there, past that 32.20 point, we have some additional support that's offered at 31.40 and at 31.20, which is also going to be that area, at least from current positioning, where the index would reach about 100% oversold territory. So definitely have some support levels coming into play here, and will be an important thing to keep an eye on here, Jay, as we look towards the election coming up there next Tuesday. And in looking at this, this plays into some of the movement we've seen from some historical election cycles as well there.
Yeah, absolutely. I mean, we've looked and you know, in terms of just historical perspective, if we go and we look at the market as it's heading into a presidential election, you know, whether it's been a outcome of a Republican incumbent or Democrat incumbent, if we go back to 1976, we've really seen a mixed bag as it relates to the market. As a matter of fact, the average 2 months leading into a presidential election is negative, is about minus just under 1%. So about a 1% loss on average that we've seen from the S&P 500 as we're heading into that presidential election. And those losses actually look a little bit worse on average when you look at the Dow, when you look at the NASDAQ composite index. On the other hand, when you look at bonds 2 months heading into that presidential election, we have historically seen positive returns coming out of the bond market. Not too surprising for a couple of reasons. One, historically, especially this year, especially 2016, and you could probably go back, even further into 2012 and 08, is historically, as we're heading into a presidential election cycle, there's a lot of uncertainty around the market. There's a lot of uncertainty around who's going to win the election, and then ultimately who's going to win is going to dictate some policy that ultimately will likely influence the markets in some way, shape, or form, and in different ways depending on ultimately who wins the election. So historically, we've seen some volatility as we head into that election process. But also, just from a sheer timing perspective, the month of September is historically the worst month on record for the market. And the month of October is a month that, while it historically produces gains on average of just under 1%, it's also a month that has seen quite a bit of volatility in its history. And so, you get those 2 months leading into the presidential election cycle. Those 2 months just happen to be September and the month of October, as the election is in early November. And so, that is certainly something that we have experienced this year. September, we saw some volatility creep back into the market. It regained some footing. We actually saw the S&P, as we saw in that chart, we saw the S&P rally 10% from the September low to the recent October high. And now we've seen that pull back here for the S&P 500. So, what's interesting is, though, where we stand right now, Ian, when we look at those numbers right now, we look at the averages of, minus about 0.9% for the S&P 500, a gain of 1.2% for the bond market. What have we seen so far this year? So since the end of August through, basically yesterday, which is almost completed that 2 month cycle, how have we trended on those historical averages?
Yeah, so if we're looking at the movement for some of these major market indices up and through this current point, so like you said, the end of August up until the end of trading yesterday, so prior to today's movement, saw that the total return for the S&P 500 had lost about 3%. We're going to be losing a few more percent with movement today, but about 3% through movement there yesterday. It also saw gold and silver have been beat up pretty bad. Silver, especially over the past few months, silver losing in excess of 13% since the end of August there, and gold losing a little bit over 3% over the same time frame. So a little bit more sharper losses than at least what we've seen historically in that 2 month time frame. But looking at a consistency factor, I mean, the bonds, the total return for the core bond ETF AGG is about flat over the past 2 months, down 0.06% over that time frame. So, I mean, while we've seen a little bit more sharper losses, as we said there, we still see that the consistency from that prior election cycles of bonds being really the only area that has continued to outperform over the 2 month time frame, holding true at least over the past couple months that we've seen here, that we continue to see AGG can outpace the other areas in what is historically a substantially higher period of volatility. And as you said there too, Jay, if we look at how this will affect moving forward, as you said, in the 2 months after that presidential election cycle, I mean, typically see the indexes post positive, at least the equity indexes post positive returns over that time frame, kind of regardless of which party is elected. That coming back to the idea, markets don't like uncertainty, right? And we're certainly in a very uncertain time right now. And so when that uncertainty is alleviated, that might lead to some more positive reactions moving through the last 2 months of the year. And you're carrying that over to a year later, again, kind of regardless of which party is elected, that we tend to see pretty strong returns a year after an election, again, regardless of which party is going to be elected at that particular point in time. So certainly will be an area to keep an eye out here, Jay, as we head through the next few days here, looking through next Tuesday, and then certainly through the next few months of the year. And another area that we're continuing to monitor and that we're continuing to keep an eye out, as you touched on there initially, is earnings. We're still in the midst of earnings season. That can, with all the other headlines going on, can be lost in the lost at some points. But in looking at the earnings scorecard, FactSet releases a weekly earnings insight report each Friday that provides some pretty kind of in-depth breakdown and some interesting points on a week-to-week basis, looking at those companies that have released up until that point. And then looking at the report from last week, through Friday there, we'd seen a little bit under a third of the S&P 500 companies reported up until that point in time, with 27% of companies in the S&P 500 reporting. And interestingly enough, 84% of those S&P 500 companies have reported a positive earnings per share surprise. 81% have reported a positive revenue surprise. So the point that they were looking at there was that if 84% for a positive EPS surprise is the final number that we end with after all of the S&P 500 earnings are released, that would actually tie the mark for the highest percentage of S&P 500 companies reporting that positive EPS surprise since FactSet started recording this data back in 2008. So on the backs of what was a pretty poor Q2 performance there, seeing that this earnings reports from Q3 have been generally to the upside and substantially so. They've been not seeming to affect the price movement quite as much as they might have in a normal market environment there. Another interesting point that they were taking a look at was for earnings growth for Q3 2020, that the blended earnings decline for the S&P 500 is negative 16.5%, again, through the market movement there on Friday, which is actually the second largest year-over-year decline. So looking at Q3 2019 versus Q3 2020, this is going to be the second largest year-over-year decline that we've seen since that Q2 2009 timeframe there. So a lot of the areas that we've seen in the S&P 500 that are posting those earnings decline on a year-over-year basis have been some of those areas that have been hit hardest by the coronavirus pandemic. Looking at your airlines, your entertainment and hotels, your oil and gas, your oil services. So not necessarily surprising to see a lot of those areas posting declines on a year-over-year basis. But definitely will be another kind of interesting point to monitor here as we move through the rest of the earnings season. In looking at ways to keep track of earnings season, and specifically looking at keep track of names in your portfolio that might have upcoming earnings that are being released, I wanted to highlight here one way you can do that on the platform is by taking a look at the security selection tab that we have up top. So it's up top under security selection, and then you go down to security screener. And then one of the database screens that we have there from the next page is going to be stocks with earnings releases. So this is going to show you any stocks that we have on the system that have announced that they're going to be releasing earnings at some point in the next month. They're going to go in, you can see the names, the tickers, the sectors they're associated with, when those earnings are projected to be reported. And you can be sure to kind of cross-reference this report here with those names that you have in your portfolios here on the site. So one place to come in and make sure you can keep track of those names to see, even as we are in a very volatile environment, what areas might have a little bit more volatility here over the next few weeks here, Jay.
Yeah, and it's absolutely right. And, you think about that and obviously, you think about the sectors of the economy that have been hit, harder than others here over the course of the past few months, and this continued uncertainty around what the future holds. We're starting to see news come out around some European countries potentially going back into lockdown. There was news earlier that came out around the city of Chicago discontinuing the ability for restaurants to have indoor seating. And so it's a situation that, the kind of whole world is continuing to monitor. Nonetheless, when we think about the markets and we go through the markets, 2020 has certainly bucked a lot of trends, as we mentioned. And one of those trends that has kind of been flipped on its head so far this year has been the whole idea of sell in May and go away, and that whole idea of market seasonality, which is one of those historical phenomenons that if you go back years, there's studies that we've done that go back to 1950 looking at the Dow Jones Industrial Average. And basically the idea of that is the vast majority, as a matter of fact, basically all of the gains that the market has seen over that time period have come during the seasonally strong 6-month period that starts in November and ends at the end of April. And that doesn't mean that every single period that's positive and the weak period is negative. But if you just go back and you look at the historical bias, if you were to just invest in the market during the seasonally strong period of the market and put, during the seasonally weak period, you put your money in some T-bills and just kind of hold on to it, you basically matched the buy and hold return of the Dow Jones Industrial Average over that time period, while historically the body of work of the seasonally weak period has produced basically no gain or no loss. It's basically been flat over that same time period. And so, that is just one of those market phenomenons that has been observed over the years. This year, we're closing in on the end of the seasonally weak period, and through yesterday, the S&P 500 was up a little over 16%. The Dow just under 13%. Those numbers are going to end slightly different between today's trading, Thursday, Friday's trading. But if we were just to take a snapshot right now, as it relates to the Dow, up a little under 13%, is the best seasonally weak period that the market has seen since 2009, when the Dow Jones was up 19%. The only other year in kind of recent history that we've seen double-digit returns in the seasonally weak period was 2017, up just under 12%. And 2017, it was one of those years, if you'll recall, that was just a year without volatility. I don't know if you can think back to 2017 and a year without volatility, but that was one of the least volatile years that we experienced in the market in quite some time on a number of different fronts. And so, and then obviously 2009 was a year coming off of the March 2009 bottom. We continue to see a move here. And then obviously 2020, you had, coming off again a March bottom and seeing the market move higher. Nonetheless, when you look back at taking out some of those anomaly years, you look at the body of work, and certainly there's a historical bias to it. So one of the things that we can do, we're not likely going to go out there and say, okay, the calendar turns to May, we're going to sell everything and just sit on the sidelines until November rolls around. But there are proactive things that we've observed, proactive strategies that we have talked about for a number of years in being able to take advantage of this just historical bias in the market. And one of those is, very simply taking, say, momentum and low volatility, pairing those two things together. So something like an Invesco DWA momentum ETF, PDP, with something like an Invesco S&P 500 low volatility ETF, or First Trust has a Dorsey Wright low volatility ETF, DVOL. You pair the momentum and the low vol, and you could do it 50-50, and that works fine over time. But if you then take that and you adjust it based on the market seasonality, then you're able to take advantage of overweighting momentum during the seasonally strong period in the market, because the November through the end of April time period has been a period that has rewarded growth or momentum type of strategies more so than low volatility. And then come May 1st of the following year, then we just go back the other way. So we now overweight low volatility, say 30%, momentum gets underweighted overweight low volatility at say 70%, and underweight momentum at 30% come May. As we turn to November, 70% momentum, 30% low vol. But during the historically weak period in the market, the market has rewarded lower volatility strategies over time more so than growth and momentum stuff. And during the seasonally strong period, the market has rewarded growth or momentum type of strategies. And so, that's one idea of ways that you can be proactive in a market environment with the historical bias. Certainly we'll continue to monitor the indicators, but that is one strategy for those of you who have access to our research platform and the models page. Those are models that we publish. And so if you wanted to kind of look at what that has historically looked like over time, there's some performance numbers out there that you could go and look at. But, that is certainly something that we'll continue to monitor as we wrap up this week. And then we roll the calendar over to November next week. We'll be sure to touch a little bit more on that through the podcast, through our daily equity reports. And so we'll be sure to stay on top of that. Before we end, I almost forgot one other thing that happened this week, or I should say two other things that happened this week as we head into the weekend. Being one with small children, Halloween is certainly on the forefront of our minds around here. So costumes and pumpkins, I think pumpkins, Ian, are getting carved tonight is the plan, or at least that's, I think, what we promised. So hopefully we'll get some pumpkin carved this evening. But then also on the same night of Halloween, I think there is a blue moon that's supposed to happen, and we need to set our clocks back. We need to fall backwards as a result of daylight saving time. So a lot going on in the market, a lot going on out in the real world today. And so, we'll be sure to keep on top of things as it relates to equity strategies, as it relates to market environments, and continue to monitor as we head into the U.S. presidential election that's coming up next week, how the markets are reacting and what that reaction is doing to the point and figure charts. And that's going to ultimately be the most important thing to us, is how is that market reaction affecting a number of indicators, affecting relative strength charts, affecting point and figure charts specifically. So be sure to stay tuned. Make sure you have alerts set on your individual stocks. If your process is to weed stocks out of the portfolio as they begin to break down. As always, if you have any questions, please don't hesitate to give us a call. Our number is 804-320-8511. You can also reach us via email. Our general email inbox is dwa@DorseyWright.com. So, Ian, appreciate you joining this week. Appreciate the insights and the perspective on the market. Thank you all for taking time out of your day, out of your week to join us for this podcast. As always, we appreciate your time, and we look forward to talking to you next week.